This is your golden ticket to start understanding how to trade gold. So in this video, I'm going to show you everything from the starting point of the strategy and even the entry point. This is going to be basically easy, so please watch the video till the end. So before we begin, read the disclaimer. So these are the topics that we are going to cover in this video. We are going to start by understanding the manipulation of the market structure, and then we are going to move on to candlestick volume, and also we are going to understand how to make the entries and stop losses. And because this is a long video, we are going to include at least 21 examples. And if you want this PDF, the slides that I'm using to make this video right now, you can find them in the Telegram. The link will be in the description below. And also you can find the Discord in the description below because I share some daily analysis. So let's begin with the video. The first thing that you need to understand is that this video is basically based on scalping, but the same strategy that we are going to talk about, you can still use it in other time frames like the 4 hours, 1 hour, 2 hours. All the time frames you can still use basically this strategy. But because this strategy is based on gold mainly, we are going to focus on scalping. So for scalping, we are going to focus on the 15 minutes time frame. This 15 minutes time frame is easy to manage, and then because it's easy to manage, you are going to look at the chart 4 times in an hour. So you are not going to be opening your MT4 or trading view every time. You can still use the same time frame, but then you can open your chart prior to 1 minute before the candlestick can close. So on the 5 minutes time frame, this one is very fast, guys, and you can easily miss a lot of trades, and you can also overtrade if you don't have a proper risk management strategy. And you will be mainly in 1 hour, you will be focusing on your chart like a lot because price is very volatile in that time frame. So what am I saying here is that it's either you choose the 15 minutes time frame or the 5 minutes time frame. I'm going to give you 10 examples on each time frames. We are going to do 10 examples here, and we are going to do 10 examples here, so that at least you can understand the full strategy that I'm going to give you in this video. So let's move on to understand the structures that we are going to use mainly on this video. To understand the structure, the pattern should always be easy to understand, and also you are going to trade above the previous swings or below the previous swing lows. So let's say for now, let's take some notes over here. Let's say for now, you see the market is moving to the upside. It makes a high here, and then it makes a low here. So from here, you will be looking to enter the market around this area here. When price breaks this previous high here, this is where you'll be looking to make your entries. So let's say for now, price did not break. Let's say we have this is the high, and then we have this low, and then you see that price is moving to the upside, but then it does not break this previous high here, and then it starts to reverse to the downside. This is where you will be looking to make your entries below this low here, this previous low here. This is where you'll be looking to make your entries here. You don't want to trade any support on or resistance levels unless if you're using the higher time frames to move on to the lower time frame to do the same thing that I'm teaching you right here. So for example purposes, you can still use your, let's say we have a supply zone here, a demand zone, I mean to say. We have a demand zone here. This will be your demand zone. So that means you know the structure, but then you can at least see a demand zone here. This is where you'll be looking to make your entries to the upside. So this is the example. This example here is the same one that I was showing you on the side. You will see that you will have a bullish candlestick here, and then you will have a bearish candlestick here. This candlestick here will build up a demand zone, and then here we have a break of the high. You can still trade like this. When price breaks this high, you can still enter for sell and still enter for long around here. When price breaks this, and then you will enter long here. There are a lot of different structures that I won't be able to cover fully in this video because there's a lot and there's different market conditions, but you have to understand where price goes. If you don't know how price behaves, you can still look at it like this. Let's say this is a price we have price here. To understand or see the price action very clearly, let's say this is a price of Coca-Cola. Here, let's say this is $1, and then price move to the upside, and then here price is $2, and then let's say $2, and then around here let's say it's 1.50. so that means you will be waiting for price to either break this high or this low. Then when price trade below around, let's say 1.25, this is where you will be looking to enter long, because you are getting a cheaper price than to sell at a higher price. Maybe let's say you are selling at a $3 price point. This is just an example. I'm not sure how much is Coca-Cola in other countries. So from here, we are going to do a little bit of more examples. You can see here, we have this low, we have this low, we have this low, and then we have this high, we have this high. But look clearly, if you were looking to enter long, this low did not break this previous low. So that means we are still in a range. So that means the market is still playing around in a range like this until we have a spike. So you can clearly see that even this high did not break this previous high. Even this low did not break this previous low. So that means we are still in a range like this. Then when price move to the upside to break this high or even this high, price action will tell you around here what to do. There is no way that price action will move without giving you a proper price action. This is where you should understand how the market behaves. And most people will say this structure here, we have already seen the structure online every time. It's like this. So many people will think that this will do something like this and then continue to the downside. Yes, it can do that, but most of the time price action will tell you, because you will see that price will correct here, shoot lower, break this low, and then move aggressively to the upside very quickly. So even if you don't have a stop loss, that means you'll be out of that trade very quickly. So let's look at this one here. This is like a correction. We have a B, and C, which breaks both highs. It's like this, both highs and lows. It's like this. We have a B, and a complete correction here. And then after every correction, when price moves to the upside, there will be a way to enter here, even around here. So what am I saying is that you should always look for price to break either the low or the high. In that way, you will understand it very clearly. But even if price breaks this low here, and then it can give you an entry, but then you get stopped. And that's the one thing that you should understand. Reality of the market. Never mind my handwriting, but as long as you can hear me, it's fine. This is the reality of the market. When you enter the market is either will give you profit, you will either be stopped, break even, no entry at all, and then what's the other thing? I think I forgot one word here, but as long as you understand the concept that when you enter the market will do something. It's either you get stopped out or you leave the market with break even. If you don't have a stop loss, this is where you will blow your account. Okay, this is where you will blow your account. So from here, guys, let's move on to another thing so that we can understand the pattern very clearly. Also, before we move on, another thing that you can add to your analysis is some supply and demand, support and resistance. Let's say for an example purposes, we have this higher time frame. You have this, maybe let's say this is your support, this is your resistance. In the lower time frame, that means here you should wait for something like this, price to break the low before it can enter your support level. This is where you will be looking to enter long. That's how you should understand this. If you don't have this structure, then avoid it. But because you are focusing on gold mainly, you will see those examples when you move forward. They are a lot. You see them every day. If you were stopped out this week and then the trade moved, you'll see it very clearly, because I'm going to use the current price action of gold based on this week's analysis. So you don't need any difficult structures to make a trade setup. So the one thing that you need to understand is how price action behave before making a reversal. This is very crucial, guys. If you look closely to understand this very clearly, right now I'm going to teach you the volume of the market. Please understand this. This is very important. You see, this is a low here. This is a low here. This is a low. This is a high. We also have a high here. But then what we need to do is the first candlestick should be very strong. And let's say in example purposes, you are looking to sell here, that means this one will be a bullish candlestick. Then number 2, for our entry candle, this candlestick should be very weak, a little bit weak, very weak, and sometimes it can reject. You will see a small spike above like this. This one should be bearish, but I'll show you some examples, don't worry. You can clearly see from this one, price was shooting to the upside very aggressively and then retraces and then moved up again, closed bearish. Oh, never mind, it did not do something like that. This one, I'm talking about this candlestick. It moved to the upside very aggressively. It corrected, moved to the upside, and then closed bearish because it did not break this high here. This impulse wave here, it was rejected by this move here. This should always be strong, okay? Like for example, we can see that price is moving down very aggressively, but then it started to be weak here. So from here, we don't even consider this one. Let me show you why. This is strong, this is strong, this one is weak. But then look very closely. We have this one here. This is very strong, better than this one here, but because we want the market to be rejected, you can clearly see on this one that it pushed the market to the downside. This will be your confirmation here. This is not your confirmation because this candlestick is very strong. I hope you understand it. So because you won't take any short positions here, even if you do something like this, you can still do something like this and say that price rejected this candlestick here. But then look closely. We have this structure here. It's like this. As I said before, you should always wait for the market to break either the low or the high, and we can clearly see based on these candlesticks here, we can see this one is very strong, this one is very strong. Most people will think that the market is very bearish based on this candlestick, but then this candlestick will prove them wrong. So that means you can take the entry from this candlestick close and then for price to move to the upside. Even this one I would have considered because this candlestick is very strong, and then sell on this one, then I'll be stopped out here. That's the reality of the market. What, you thought this is 100% strategy? No, it won't do something like that. Forget about it. If you're still thinking that trading is about 100% winning strategies, that will never happen. So let's look at another one here. You will see them everywhere. Let's read this candlesticks here. We have this candlestick is very strong, and also guys, this candlestick should never be, the body should never be bigger than the previous candlestick. So what I mean is that the first candlestick should have a bigger body, and then the second candlestick should have a smaller body. Okay, so we can clearly see that here. That means we take the entry from, let's say, on the close, and then we put our stop loss above here. From here, I would question this trade because this area here is very huge. So I won't even consider it. But it's a perfect entry even though I will be stopped out here. So that means right now I still have this loss here. So because we have to also follow our trading plan. This is very crucial, guys. Then we can see on the next candlestick, we have a very strong candlestick. And also it broke this previous high here and then also closed bearish with this candlestick. This candlestick is very strong and then it got rejected. That is why you see this move to the downside. Okay, I hope you understand it. So that means we have lost this one. This one was a loss based on this area here, and then we win this one here. But then you can also let's say you don't want to take this kind of candlesticks here. You can focus on this one only. It doesn't matter. Focus only on candlesticks that have a smaller body because the stop loss will be very small. This will be a stop. And also don't forget to add your spread size here, spread size above, and you can clearly see that after this move to the downside, price broke this low, made the same thing. It's just that this one is a rejection and then price shoot to the upside. But then from here, we don't have any stronger candlestick. This one is an bearish engulfing candlestick, so it's not very strong. And as I said before, this first candlestick has to be bigger than the second candlestick's body. So even from here, if let's say you can see price is breaking this low here, but then look at this, the first candlestick has to have a bigger body and then the second candlestick has to have a smaller body. But in this area we can see that we have a candlestick with a bigger body, the second candlestick here. So that means our setup is invalidated. Then when price moved to the upside, it broke this high. You can see that this candlestick is very strong. Even this one here is very strong. But look at this candlestick's body. It's not even that strong like this candlestick. I mean, the body is not big, if I may say. So you can enter the market right here, sell, stop above, and then you can see a massive move to the downside. Obviously, if this was a 15 minutes time frame, you enter here. This is just a 1 hour entry. You trade this and then you are done for the day or week. It depends if you are an aggressive trader or not. These examples will repeat every time. Look at this one. We break this low. This candlestick is very strong. This one is having a smaller body. You can enter here, but this one is very risky because the stop loss will be huge, because entering here is not good, guys. And then we can also see that we break this high, but then this one will be avoided. Even this one will be avoided after breaking this. So that means we avoid this kind of things. So let's look again. We have this low. Let's look. Is the previous candle very strong? Yes. Is this one having a smaller body? Yes. Did we break the previous low? Yes. Then move to the upside. And look, guys, because we have all red candlesticks to the downside, this is the previous high. Anything here is nothing because we don't have anything here. So let's move on to more examples so that we can understand this. This is a bearish entry. This is a bullish entry. Sometimes you'll see this will be your rejection. This will be your rejection. This here will be your, maybe let's say this will be your inside bar. Mostly this will be your inside bar. Even this one, inside bar. This is all your confirmations. And don't worry, guys, this PDF will get it in the Telegram or even the Discord. You just have to find it. I'll just read the date of this video so that at least you can find it and understand and practice on this PDF. And this is not paid, this is free. I'm giving away this free, guys. So the inside bar, meaning the body or the price section of this candlestick, is inside the first candlestick. I just call this the first candlestick. You can call it whatever you want, as long as you understand the concept. It doesn't matter. So on rejection, you will see price will be rejecting. It will trade above the previous candlestick's high, and then it will close bearish. The bearish candlestick, this will be your confirmation. This will be your confirmation. If you don't want to confirm with this one, you can put a sell limit order here, sell limit order, for in case if price breaks to the downside, and then it will confirm your stop loss should be above. There's no need to put your stop loss very, very high, because what's the point of doing that? If you don't trust your strategy, then find another one which is very comfortable. Even this one might not be for you, but as for me, I can use it very efficiently because I love price action very much. There's no need to put some lines on the chart. It's just for demonstration and to mark up some points. So let's look at this complicated chart over here. This one is very complicated. You can see where we have the dots is the highs. This is the highs. And then here we have the lows. We have the lows. We have the lows. If we read price action from here, guys, we can see that price broke this high, made this candlestick, and then it shoot to the downside. But then price also broke this low, because let's say maybe you entered the market around here, because price action will be reversing. Let me do something like this. Entered the market right here, and then you catch this. Once you see this, that means you can still close that trade and then enter another one here. And if you look closely, this candlestick is very strong. This one is not. Then you enter the market here, stop loss here, and then you trade to the upside. Then look at the body of this candlestick. Is bigger than this one. And also we traded above this previous high. We enter the market for sell. Even though if you are holding, this move could have easily stopped you out. Maybe this was news event. I just wanted to show an example with a complicated chart, because if I don't do a complicated chart, you will think they are very easy. But when you reach on to the market, let's say you watch this video and then you find the market doing something like this, you'll have a headache and think that everything that guy showed me on YouTube did not work. But you have to at least backtest a lot, because if you don't backtest a lot, there's nothing that you're going to benefit from this video. This will be like a Netflix show. So you just have to go and backtest. I'm doing this for you so that you can at least backtest. So let's look. We break this low, but then from here, we don't see this one is bigger. That means we avoid it. And then we have another low here. You can clearly see that this candlestick is very strong to the downside. What I mean is that you will see that the market will move something like this, and then suddenly a sharp move to the downside. This will be reversing. This is the same thing as I did on US 100. I made that setup because it's based on the structure. If you remember, we had a move like this, and then suddenly a sharp move to the downside, and then I entered here. I've been holding that trade for more than 40 days now. You can come to the Telegram and you'll see it from the starting day when I shared that setup, even showing you how I manage that trade. So it's the same thing. You can see a sharp move to the downside. This is where you enter. Most of the time you'll see these things happening, maybe news event, because in news event you will see that the market will be studying like this and then it will move up aggressive. This is where most people get trapped, because the market was just closing the correct price action, and then you enter here and then you go down with the market. The market can just, let's say the market is moving to the upside, and then during news event it start to push higher like this and never stops. No, it will start by doing something. Let's say it's moving like this. Let's say we have a low. It will do something like this very aggressively and then move to the upside. This is where you'll be looking to enter the market. Like even on this one, you can see this is very strong move to the downside, and then suddenly a reversal. Most people will sell using support and resistance here. I don't know how, but they will be trapped. I know some people who don't use a stop loss, and then they will be trapped by this whole move here. If you're entering here, put a stop loss, and then the market takes you out and then move on another setup. So because right now I believe you understand everything that I have been explaining in the beginning of the video. Right now I want to show you some few examples. We are going to do the 50 minutes on gold, 10 examples, and then we are going to do 5 minutes on gold, 10 examples. 11 examples on gold on the 5 minutes time frame. And also, don't come to the comment section and bite me. This is for educational purposes only, or for entertainment. Yeah, I'm using old price action just to teach you how to understand this. If you want real chart examples, come on Telegram, I'll show you that, because someone is coming to my comment section and bullying me, but I'm not getting bullied very easily. So let's begin with the first video. This is the first example I meant to say. Here we can see that the market is moving to the upside, and then we have the low here, and then we have this high. But here is the problem. You can see the market is still ranging. So that means we have a structure like this. So that means here we have to wait for the market to at least break to the upside to take a sell, or break to the downside to take a buy. The market will tell you where am I going. And before the market can reverse, it has to make a sharp move to the upside or to the downside. If we look closely here, this bearish candlestick is very strong to the downside. And then we have this inside bar. As I said before, you can put a stop loss here, and then if you want to enter, you can use a buy limit. This is also the 15 minutes time frame, and or maybe on the close. Also, don't forget to add your spread size here on the entry. So that means right now you enter the market and wait for the market to move to the upside. This is how the market did. But because you have this huge profit here, you see that, okay, the market broke this high here. So that means I can take the sell and do the same thing. Yes, you can, because right now you don't even know the price action. Are you going to take the sell? Okay, are you? Because you are still in this one. Are you going to take the sell because price broke this high? Or are you scared? Tell me, comment below. So from here, let's say you take the sell. Okay, let's see how the market behaved. Okay, you got stopped out, but you have this profit. Why are you worrying? Are you going to take this sell now because you got stopped out here? Are you going to take the sell? Tell me, take that sell. Let's see. Okay, you benefited from this one here. I hope you understand it. You are going to lose some trades. Right now, you have one win here, one loss, one win here. And you can clearly see that this is a small loss. These are big wins here. Look at this move here. It's very strong. Even if you see that price broke this, you won't even try to take this one because this candlestick is very big. Even this one, you won't even take it because this candlestick is very big. Even this one. So from here, let's look. You take this sell, you get stopped. And then you try again. You win this move if maybe you are managing the trade properly. Let's say you take this one, stop loss above, you got manipulated, and then price move to the downside. That's how the market behaves. Let's look at this one here. Let's start by reading price action from here until here before we can move on, so that at least you can get this thing inside your head. We have this price move to the upside, reject, it shoot to the downside. Let's say you see this low, you enter here, you move to the upside, price breaks this high, you take the sell. So you are asking me a question. If you're asking me a question, why this sell here? This body is bigger than this one, but even though this candlestick is not very aggressive, you have to think like calculate it very properly. So let's look. This one, I won't even take it, even though it moved to the downside and break this low. Is because we don't have a price breaking a high. we just have a move like this. Price did not break any high or low, so that means we are going to avoid this one. And then we have this. Okay, you can take this buy, target this previous high, and also you can see this candlestick is very strong, this one is weak, and then this candlestick is very strong, this one is very weak, and also price traded above. You sell on the close, price move to the downside very aggressively, and then look closely. Price after breaking this candlestick is very strong, and then price gives you a rejection, price move to the upside. I hope you understand it very clearly right now. And then let's say right now you say price broke this, and then you take the sol. This is a loss. This is a loss. Then you wait for another setup, and then you see another one. Let's say you see that price is breaking this high. This one is also another L, but because you've been coming back making profits from here. What more do you want from this strategy? Let's see. This one I won't even take it. So right now, let's say you see that price is breaking this, and it was coming very strong to the downside, and then it broke this. It traded above this price point, and then makes this inside bar. And then let's see how the market behave. It moved to the upside, and then you catch this move because you have several losses like this one, but you have big wins. That's how you should always trade. So you take this entry and move to the upside. That's how at least you should understand. Okay, and then from here you can see that price is breaking the high. And then we have another candlestick. Let's see. Okay. I think I did not add that one, guys. I'm sorry. Oh, okay. We have it. Here it is. And then enter the market. Then you get stopped out by this candlestick here. But you don't have to worry about it. Okay. Let's continue. I was taking a break. So from here, this one will stop you out. And then when you continue, you can clearly see that price broke this one. But based on this candlestick alone, it won't even convince me to enter the trade. Because if I enter on the close here, this candlestick is very big. I know it's not bigger than this one, but the risk will be very high. So basically, you can clearly see that this one is very huge. Even if, let's say, you are targeting around here, but the risk to reward is not in my book. I like to see a candlestick this small, even like this small. You can clearly see that this is very low risk. You enter here, and then your target is very high. Even if price hit here is very perfect. Unless if you are going to risk small here, but you'll eventually be stopped out. So in this case, you have to avoid it. So then we move forward. You can clearly see we have lows, and then we also have a high here, and then we have a high here. Also this high. Okay. So if we look closely, this high here, let me draw the structure. It will be something like this. We have a low, we have a high, we have a low again, and then we have a high. You can clearly see that price broke this. If we look closely on this candlestick here, it's very big. I mean, the momentum is very big to the upside. But then suddenly we have this rejection after breaking the previous high here. So that means this candlestick is our confirmation. Then we sell to the downside, and after selling, you can clearly see that price also broke this with this candlestick, which is very big too, and also rejected. If you took this one, that means you'll be stopped out immediately. But then this is a small risk. You have this profit to the downside, and then also, let me see, we have this profit to the downside. You can clearly see that price also broke this low here and made the same thing, and then you have the profit to the upside again. And another thing is that you can see another setup here. For me, you take the sell and another one here. So in this case, are you going to take this buy? Because you can see price traded below this low, and also we can clearly see that price is also on the demand zone here. Are you going to take this buy to the upside? You can comment below. Example 3, yes, I'm going to take the buy, or I'm just going to leave it. Okay, let's see. And then boom, you have this massive move to the upside. You just have to read candlestick patterns. Let's move on to example 4. Also, don't forget this is the 15 minutes. On this example 4 is basically almost the same thing. You just have to read price action. Look, we break the high, we check the candlestick is bigger, yes, and then we check the bearish candlestick, yes, and then we enter short. You can clearly see this one is very close. The candlestick body is not really, it's bigger, but it's not too much bigger. And then you enter long with this one, and then wait for price to move to the upside. This one, yes, but then you will be stopped out by this candlestick here. This one you won't even try to take it because this candlestick is bigger than the previous candlestick's body, so we avoid it. Let's look at this example here. We have, look, this is the low here. Price, you can see on the first candlestick we have a bigger body, and then on the second candlestick we have a smaller body, and also this is an inside bar. You can clearly see that this candle is inside this one here, inside this bearish candlestick. You can put your buy limit order, enter at the close, and then you catch this move to the upside. And some of them can be very difficult to identify, but that's a problem for another day. And also, if you look at this one here, you can still enter short here, but then you'll be stopped out immediately. So let's move on to another example. This one is just a mess. Yes, I have to provide this kind of patterns so that at least you can understand them. This is the same thing as this one. Example 4 is just a continuation of example 6. This move here is very big, so I won't even consider it as a buy because my stop loss will be huge. So I won't consider this kind of trades. This one I won't even take it because we don't have a break of structure here. And you can clearly see that we have the high. We have the high here. Price broke it, and price also entered the supply zone, but then this body is bigger, so I'm just gonna avoid it. And then let's look. If you consider this low, then you can take the buy. If you have considered this high, you can take the sell. If you have considered this low, you can take this buy to the upside. If you consider this high, you can take this sell to the downside. You can see pretty much it's very easy to understand. Let's see this one. This one could have stopped you out. Let's see. This one is having a bigger body. Yeah, avoid. This one here could have stopped you out with this move, even though your anticipated direction was correct. Let's move on to example 7 here. Starting to be a little bit messy here. We have this high, you take the sell, and then where's another example? Oh, it's the same thing. Okay, it's the same thing. I guess example 7 is just the same thing. We are just going to avoid it at the moment. Or you can say this is the low, this is a strong move to the downside, and then we have the smaller move to the upside, and then you take the buy. But this candlestick here is very big, so our stop loss will be very huge. So that means in this case we're going to avoid such trades. We have this one over here, buy. Why? Because price broke this low. We have a bigger body, and then we have a smaller body which is also bullish. You take it to the upside. Here long, here long. And another thing that I want to point out is that, let's say right now you enter a sell, but this one won't be a sell because this candlestick doesn't have a bigger body, but price dropped very aggressively to the downside. But this candlestick here is a bullish engulfing. This one here is based on another video that I'm still making, but you can still test it, but avoid it for now. So from here, let's move on. Example 9, we have a low, aggressive move, bullish candlestick, move to the upside. This candlestick did not break any high, but then we have a move, strong move, small move, bearish candlestick. You take the sell to the downside. Same here, aggressive move, bullish candlestick, trade to the upside. You can pretty much see that this is very simple, guys. You don't need anything. Let's see. Aggressive move, better than the previous candlestick. We avoid, and then price move to the downside. You can clearly see that this is pretty much simple to understand. I hope you understand it. Let's look at the last example on the 15 minutes time frame. We have this high, we have this low, aggressive move, but not really. You take the buy, you get stopped. Okay, yeah, you can clearly see that you'll be stopped out. Aggressive move that breaks the previous low, bullish candlestick, you take the move to the upside. But then suddenly, if you don't manage your trade, you will be stopped out on break even. You have to manage the trade. This video is not this is not a management video. Let's move on to example 11 on the 5 minutes. This time frame here, you're going to miss a lot of entries. I have to be honest with you. You're going to miss a lot of entries, a lot. Let's look here. Aggressive move, bearish candlestick. You take this sell. Once it breaks this low, you can put the trade to break even or close some. I'm not gonna touch on trade management here. Aggressive move, small aggressive move, and then this one. Then you'll be stopped out. But I don't usually like to take this one because price is just like this. There is no direction. There's no proper direction in the market. So price is still deciding where to go. So most of the time I like to avoid this one because it's just a mess. A high, aggressive move, you take the sell. A low, aggressive move, bullish candlestick, you take the buy. Here, this candlestick is very big, even though price shoot to the downside. In this 5 minutes time frame, you have to be very fast to think and analyze and be able to make your entry. So most of the time you'll be opening your charts while, let's say maybe you're using a phone to make that entry. You have to be very precise with it. Let's see this one. Example 12. You have this low, and then we have this high. You can clearly see that price broke this low and this low. Price also entered the demand zone. Aggressive move. Bullish candlestick with a smaller body, and then you take the buy. Aggressive move, but this candlestick did not break any low. Okay, I hope you understand it. This red candlestick did not break this low. Okay, and then enter the market right here, and then you hold. Let's move on to another example. Let's see what's happening here. This is the high. Price broke this high. Aggressive move. Aggressive. This is also an aggressive move because of this wick here, and then we have this rejection. But as I said before, I don't like this one. We have this low, aggressive move, rejection, price move to the upside. Here we have the high, aggressive move. You enter the market, you get stopped. This is the reality of the market. I'm not going to show you something that you think you are going to profit every day, but when it moves, it moves. Example 14. Let's see. This is the low, aggressive move, aggressive move. This one right now is rejecting to the downside. But then we have this bullish candlestick. You catch this move to the upside. Maybe target here, here, or here. That's how you should do. And let's see this one. Aggressive move, rejection. But the stop loss will be big here. I don't like it at all. We move on. This one here. What's going on? This is a mess. We have this low, aggressive move, aggressive move. We have an inside bar. You enter the market right here. Catch this move here. Catch this move. Very simple to understand. Let's look at another example. Aggressive move, and then we have this one. You take the trade to the downside. TP here. That's how simple you should understand it. And then another one. We have these two highs here. Aggressive move, bearish candlestick. You take the sell. And there's another way to make sniper entries here. I've been making those kind of videos for a very long time. So I just stopped making them because I've been sharing them a lot. We have this high, aggressive move, small candlestick with a body. You take the sell to the downside. But you have to be fast in this time frames, guys. This is 5 minutes time frame. Okay, let's look at this one. My lines won't be straight. Aggressive move, bullish candlestick. This is an inside bar. You take this move to the upside. And another thing is that after taking this move, you can see aggressive move, breaking this previous high, and then another inside bar. You take the sell to the downside. That's how simple it is. You have to understand it. Okay, let's see this one. I hope this line can be a little bit straight. Aggressive move, bearish candlestick with a smaller body, and then you get stopped out. Small stop losses only. You can do this every day on every pair. I hope you understand it. Let's move on to example 16. There's a lot of examples in here. Let me see this one. Okay, this one did not break. Aggressive move. This week, I don't like it. Okay, you have this one. Aggressive move, bearish candlestick, it dropped low. Let's see, aggressive move, and then entry, it dropped low. Simple. Even this one, aggressive move, this is a low here, and then you enter. Even here, but this one are very close. Aggressive move, you enter, breaks the high, aggressive move, enter the sell. Okay, also don't forget that price has to break a low. We have a low, have a low, have a low. Even if I draw a chart here, it will be something like this. You can clearly see that it aligns very well with these candlesticks. So low, low, aggressive move, rejection. Price also entered the demand zone, and you can also see that this is a break of structure. You enter here long. There's a lot of examples on this 5 minutes. Wow. Let's say this is an aggressive move. You'll be stopped out, and then we have aggressive move, stopped out again, aggressive move again, and then we reject, and then you catch this move. You see, 2 losses and then big win. This one is small losses. I hope you understand it. Let's move on. This one, where did I put that example? I don't even know. I'm going point blank here because you can clearly see that this video is very long. Aggressive move, rejection, drop low. Unless if you want to take this indecision candlestick. Even this one here, aggressive move, price traded above this high and then rejected. Trade this to the downside. And also, this will be your confluence because we have a impulse and then we have a correction here. And then you enter here for the market to drop low. And then we have this lows here, aggressive moves. You enter, you get stopped out with this candlestick. But there is a way to trade this kind of candlesticks here. But I'm just not going to talk about it. It's going to make my brain to explode. Maybe in the near future, maybe in 1 year or so. So let's move on. We have this high, aggressive move, rejection. This is pretty much everywhere. Look, we have this low, we have this low. If you don't see this low, guys, let me draw something. You can clearly see that we are going down and then we're moving high. We're going down, we move high, and then we go down. This is like this. And as I said in the beginning of the video, that you have to trade below the previous swing or enter the trade above the previous swing high. This is where you should be looking to enter the market, and you can clearly see it here right now. Let's spot the aggressive move here, and then we have this candlestick. You enter, stop loss, move to the upside, it breaks the high, take the sell, drop lower. That's how simple it is to trade gold. Don't have to complicate things. Let's move on to example 18. We're getting very close. We're getting very close, guys. Let's see. Okay, as I said before, you have this high, aggressive move, you enter, stop out. One, you have one loss. Let's do something like this. Trade, let's say this is our trading journal. We have one loss, one, and then you have aggressive move, breaks this high, you enter, another loss, plus one. Aggressive move again, you enter, loss, because this move stopped, plus one. 3 trades, losses here, and then aggressive move again, and then this move here, then you take this move down, win, it's close to 1. But if you calculated, I forgot to calculate the risk here, but here these losses will be recovered when price reaches around this area here, and then you take this big profit. So that means we have a big win on one trade only, even if you lose 3 trades. But this here will be used when we focus on mostly on risk management, your broker. There's a lot of things that you have to consider when calculating a trade. Okay, I don't believe there's no entry here, no way. So there's nothing here. Okay, moving forward. Okay, I think we have talked about this area here. Yeah, we did talk about this one. I think it was example. Yeah. The previous example, we have talked about this area here to trade lower. Let's move on to example 19 right now. Let's see. We have this high, aggressive move, bearish candlestick, you enter, go short. Right now we have this low, aggressive move, indecision candle, I don't like it. And then we have this low, aggressive move. This move is a bullish engulfing, so we avoid it. And then we have this high, price broke, aggressive move. This one will have a huge stop loss. I don't like it at all, guys. I don't like to take this ones here. So then we have this high, aggressive move, we have this candlestick, and then you enter short. You can clearly see that this wick is very huge. If you're going to trade it, you're going to put your entry here and then your stop loss here. This is very big. And then we have this low, aggressive move, rejection, enter long. Guys, this is pretty much simple, but you'll get this PDF, so it will be very empty, so you're going to practice on it. You can still print it out and then do everything that you need to backtest on it. We have this low, aggressive move, super aggressive, and then have this one, market push the upside, and then after breaking this high, aggressive move, rejected, and then it dropped lower. Sorry if I'm being fast, I'm just tired because this video is very long. Oh, we talked about this one. Okay, another one is still this one, aggressive move, bullish candlestick, trade to the upside. Let's do the last example of this video. Low, aggressive move, bullish candlestick, you trade to the upside. Another one, aggressive move, rejection, trade to the downside. If you have considered this low, you will be stopped out because price just did something like this. And then also, if you were stopped here, you mark your low, aggressive move, price rejected, and then price shoot to the upside. So even if you lost this trade, you get this profit here. I guess this is the end of the video. Please like and subscribe. Share this video with your friends who don't have a trading strategy. And also come to our Telegram. Don't forget to join the Telegram, guys. I guess I'll see you on the next one. Ciao, ciao. Hey, don't forget to subscribe.